Hi, everyone, and thanks for joining today's session. I'm Jeff Sherman. I'm the Deputy Chief Investment Officer at DoubleLine Capital. Today, I'm going to give a presentation that is focused on trying to maintain purchasing power, we call stay ahead of the Fed. And given the latest objectives of the Fed, and they've achieved somewhat of their inflation goals, but we know that inflation is still running at elevated levels, I want to discuss with investors today potential opportunities to try to help maintain that purchasing power. That is, try to get a rate of return and yield that is at least keeping pace with the inflation rate that we're seeing over the next couple of years. And so with that, let me move on to my first slide here within the presentation. And so what we're going to do, as I said, is how do investors maintain their purchasing power in today's environment? A very important thing, because it's not just about nominal yields and the amount of money one can make here, but also trying to keep pace with the inflation rate. And so one way to think about this is that when thinking about fixed income investing, what I'm going to show is that yield is a very good predictor of future rates of return. However, we have these inflation levels as well as expectations that are currently elevated. And so one thing that investors can do is avoid some of the traditional parts of the fixed income market. And by no means am I saying go to alternatives or do option overlays or something that's exotic to replace your fixed income portfolios, but moving outside of traditional treasuries, commercial paper, and corporate bonds to go out and find new opportunity sets. And so these non-traditional areas offer attractive relative yields. They also had the potential for increased relative returns, as some of these areas still, some of the securities can trade at a slight discount to par. And more importantly, they have diversification benefits, not just with these traditional parts of the market, but also within these non-traditional areas. And so from there, I'm going to try to give you some key takeaways so you can remember when discussing with your clients today. And so here's an example of what the path of interest rates potentially could look like. And so this is what we call the dot plots from the Fed. And the Fed every quarter on at their FOMC meeting releases what's called the Statement of Economic Projections, or the SEPs. And so the market likes to call them the dot plots, because what they do is they aggregate the views from the various Fed governors or where they think interest rate policy will be at the end of each calendar year. And you can see here that at the end of 2021, the expectation for every Fed governor is that we will maintain the low interest rate environment, and we will be between 0 and 25 basis point on Fed funds rates. However, you can see that in 2022, there is the expectation, roughly a little less than half thinks rates will still be where they are today. There's about, let's call it 35% or so that think rates will be one hike between now and then. And there's a few of them that think there'll actually be a couple hikes. But then by the time you get to 2023, all consensus is out of the window here. If you take a look at this, what you see is that the estimates are all over the board. So it just shows the level of uncertainty, not within just markets, but also within Fed governorship. And so that purple line you see on the screen there, the blue line you see on the screen, is the median dot plot. That's what a lot of people like to quote as saying what the expectation for the Fed policy should be. And you can see here by the end of 2024, approaching about 1 7/8 as that target rate. So low by historical standards, but it's a long way to get there. And there's another line on that chart which shows how the market is in pricing the rate hike path too. And you can see the market's a little bit above the median plot for 2022. It's a little under for 2023. And the market is fading what the Fed governor's kind of median projections are in 2024. So the idea here is that interest rates on the front end of the curve are going to be suppressed and likely low for the foreseeable future. And so what this means is that it's very difficult to hide in cash as an asset class today, as you find that there's just not a lot of yield opportunities out here. And what we've shown on this screen here too is what I'll call the term structure of interest rates out to the first year. And so things that are money market surrogates, as you can see on the left-hand part, these are money market eligible securities. And going out to 1 year's time, they really don't offer a significant amount of yield. That's if you're looking at the T-bill market, or even trying to go into things like commercial paper where you're taking on some credit risk. And even further, if one is willing to take a little bit of interest rate risk within their portfolio, even out to 5 years, what you see here is that corporate bonds really do not give you significant yield in today's market. In fact, all segments of the corporate bond market, except the lowest rated tier, which is BBB rated, yield less than 1.5% today. And so that yield being less than 1.5%, as I'll show, is significantly lower than the rate of inflation. So what that means is that even if you're generating a yield without defaults in the marketplace of 1.5%, that's not keeping pace with the rate of inflation today. And so one way to look at inflation is you can look in the rear view mirror. That's what we get when we get the economic data set. It tells us what inflation was. But another thing you look to is something called the TIPS market, or the inflation protected securities that are guaranteed by the Treasury. And you can deduce what the implied inflation rate is in the market today. And if you look at market pricing for inflation, it's what we call the break-even inflation rate. It's 2.53% today for the next 5 years. So what that says is that the bond market is expecting inflation to be about 2.5% for each of the next 5 years. Now, it won't be precisely that, but on average, that's what you should expect to see. So notice here that prior to the pandemic, inflation expectations were hovering in the low end of the 2 range. We got very depressed when we had with the pandemic, the closure of the economy. And notice how there's been this resurgence in expectations. So albeit these break-even rates are off their highs that they were over the course of really, let's say, earlier in the year, about the first quarter, they still remain elevated relative to history. And so even though there's this idea with the Fed that inflation will be transitory, what you've seen here is the bond market is saying, well, potentially it's transitory, but it's at a much higher level of inflation that we saw prior to the pandemic. And so one way to think about this when I'm thinking about purchasing power is to take what I get in terms of what I'll call the nominal yield or the stated yield on those assets, and I'll subtract the break-even inflation rate. And that's what we call the real yield. And so what this shows you, it's a similar graphic to what I showed 2 slides ago. The difference here now is that adjusting for inflation, it says that you're going to erode your purchasing power by investing in these assets. So there's nothing wrong with losing a little bit of purchasing power in the short term if you think there's the ability to reinvest in higher areas or higher rates of return over the future. But if you have this expectation of low interest rates for the next year to maybe potentially 3 years, it can be very problematic as you're losing purchasing power from your fixed income portfolio. So one thing to think about is, okay, how do I set my expectations for future rates of return? And so I mentioned at the onset that the best predictor of future rates of return happens to be the yield. Okay, so if you look back at the chart, what we were showing there is the starting yield on the asset class. And what that is that gray line in the graphic. So you look at the gray line, it says, what is the yield that I expect in the marketplace there? What is the observed yield? And I'm sorry, I apologize. I said the gray line, it's the blue line, because we're actually in 2021. So that blue line shows me what the starting yield of the short duration Barclays aggregate is, the Barclays aggregate 1 to 3 year index. Why do I choose that? Well, the 1 to 3 year index, it doesn't take significant amounts of interest rate risk. If you look at the Barclays US aggregate, the duration or interest rate sensitivity is about 3.5 or 3.25 times what you see on the front end of the curve. And so what you see here is that not only are the yields low today, but notice how correlated that blue line is, what is the yield, to the subsequent 3 year rate of return. And if you look here, you can see that when yields are low, then future returns are low. When yields are higher, future returns are higher. And so another way of analyzing this is to go in statistics, but you can just see here from your eyes, very good chart to use with the clients to say, okay, you did get a decent rate of return for the last 3 years on the asset class. However, now that yields are significantly lower, you have to reframe one's expectations. And so again, to get statistical, we're mathematicians, you know, a lot of us in the fixed income market. And what you can see here is that what we do is now we take each observation and we say, okay, what does the starting yield look like? Okay, and what you see, that is the starting yield here is the horizontal axis. It tells you, okay, what did I start with my yield and what is my subsequent return over the next 3 years? And so you can see here that there's a very tight relationship. You look at the graphic there, it tells you that you have a high R squared. That means you have good statistical significance. But what you really want to focus on with your client is it says, okay, what's the implied rate of return? If this relationship is still to hold, what you would see here is that you have a big challenge here where with a 39 basis point yield or let's call it roughly 0.4%, that implies that the future rate of return will only be about 56 basis points, right, per annum. And so that 56 basis points per annum means that you are significantly lower than the rate of inflation we see today. And so the challenge you have is that these traditional vehicles may not be able to maintain purchasing power. If you can only expect your short duration portfolio to generate roughly, 0.5% per annum, that is way lower than the inflation rate we're observing today. It's significantly lower than the expectations of the bond market of the next 5 years, but also it's way lower than the actual inflation rate has been over the last decade or so. So we think the idea here is that focusing on these sectors of the market, the traditional markets, things like treasury bills, things like short duration treasuries or very short duration notes. Also looking at corporate bonds in those areas. Because there's been this amount of cash going into the market, there's been a lot of support from the Federal Reserve, there's been a lot of demand for investors, it's driven yields down significantly. And why has that been the case? It's because of the health of the economy, the state of corporate America. They've shored up balance sheets. There's very benign default risk within the high quality corporate bond market, and that's reflective of pricing. So instead of focusing on these assets, we think that if you're trying to at least take a little bit and step outside of the money market, focusing on these other parts of the market can be very accretive to the overall portfolio. And so one way to think about what's happened over the last, let's call it decade or so, if you look at just the 1 to 3 year index, it was roughly in line with inflation. You can see here the annualized rate of return was about 1.6%. Inflation ran about 1.75%. So you kept on par with it. If you lose 10 basis points per annum over 10 years in purchasing power, it isn't as harmful if you're losing a couple hundred basis points per annum. But if you look at the ultra short category, it lost about 0.5% or almost 0.6% per annum versus the inflation rate, and really stepping out of that ultra short to the short-term category at least led you to keep lockstep with the inflation rate. And so you can see here that black line on the chart. It's really accelerated, as we all know, with those inflation, what's transpired since the pandemic, with just the amount of money sloshing around the system, the supply chain issues, and the multitude of factors that have been driving inflation rates higher. So again, you've got to be cautious of extrapolating the past, but also thinking about that relationship between yields and future returns. It says that potentially some of these asset classes aren't going to be able to maintain that purchasing power. So if you look at the current yields in the marketplace, you can see here, this is data to support all my comments thus far. The traditional fixed income sectors, when you look at them in aggregate, when you start to pull all these things together, things that are in the Barclays US aggregate on the short end of the curve, what you find is that all of them yield less than 1% today. So again, with an inflation rate expected to be about 2.5 or so, what's an investor to do? So you can step out the credit risk spectrum. Obviously, there's more risk taking on high yield securities or bank loans in the portfolio. And I would not recommend that an investor just goes out and builds an entire portfolio of these below investment grade assets. But you can see here there's things that are high quality on the left-hand side of that non-traditional. Things like commercial mortgage-backed securities. Single A rated ones yield north of 2% today. Triple B rated, they yield 2.5 or 2.25 times what you can get in the corporate bond market for comparable credit quality. Now, it's not very easy for an investor to go out there and buy these assets. It needs to be professionally run. You need an institutional type of manager to do that. But notice that the yield opportunities here, asset-backed securities, things that focus on the consumer, that focus on parts of the market, like you could talk about hydroelectric power, that generation there. You could talk about transportation, things that benefit from the continued strength of the economy that are very attractive. things like the loan market, but repackaged up in the CLO market that allow you to be able to get some subordination, get some protection in that, and rely on the structure to generate an outsized yield relative to traditional assets, but really take low incremental risk. So obviously you don't want to build an entire portfolio of emerging market securities, but what I'll show you is that if you use a broad diversified portfolio of assets, you can get something that looks relatively attractive today without taking significant amounts of credit risk, in my viewpoint. Now, the challenge that you also have here is that going out to some of these sectors of the market is that as you go out and take more, if you take more duration risk or interest rate sensitivity, is that you're going to be subjected to the whims of the fixed income market. And you've seen that in the last month or so, right? You've seen that where the market has repriced interest rate risk. And so not only do you have to worry about the yield, but the duration. And so one little heuristic I like to use is something called the yield to duration ratio. And it's this nice intuitive appeal. What it tells you is that how much can interest rates go up over the next 1 year, assuming I have no defaults in my portfolio? How much can interest rates go up to where my prices will not decline more than my yield? And notice that in the Barclays Ag 1 to 3, that answer is 0.21%, 21 basis points. Notice that the Treasury market, 15 basis points. So if rates reset 15 basis points, you'll be left with a negative nominal rate of return, not just a negative real rate of return. And so when I take a look at all of this, what I find is that some of these other areas give us much more protection against that interest rate sensitivity. So another way to look at that is take this graphic that I put together on slide 15, and we can show dots here. And so if you zoom in on the chart, you can see here that things that focus on the lower duration part of the chart, so the things that are on the left-hand side of the horizontal axis, and to the higher side that generate more yield, are things that are relatively attractive there. And you can see that Barclays Ag 1 to 3 really has a low yield to duration ratio. And so although it doesn't have significant amounts of duration risk, it doesn't have enough yield to offset some of that as well. Lastly, I don't like to focus on correlation matrices, but if you look at that green little area, what I'm showing here is that if you step into some of these asset classes with your existing portfolio, what you find is that they have very low correlation to this traditional parts of the market. So they also, not only do they give you incremental yield, but they provide potential diversification benefits. So this is not the easiest thing to do. You can't do this with a bunch of ETFs. You can't pull this together. You really need to buy professionally managed products. And so when I think about the key takeaways here, we have a low yield environment. We have an inflation rate that's been printing above what we've seen in the last, really, it depends on which measures you use, whether it's the last 15 or the last 30 years. And so I think that inflation is not going to remain as elevated as it is, but it's not going to subside anytime soon. I actually think that potentially inflation can even come in above those expectations of 2.5%. And so with the Fed stepping back from its bond purchases, that means there's less support for U.S. interest rates. That means potentially rates can go up from here. Secondly, the short maturity assets, they don't have a lot of yield because people have piled into those looking for alternatives to this traditional money market securities. And so the unprecedented policies have really driven rates to a very low level. And right now you're not keeping pace with that inflation rate. And so we think that these traditional short maturity vehicles are not the best way to try to maintain some of the purchasing power in your portfolio. So what is the opportunity set? It's find assets that should give you diversification. It should give you lower correlation to other parts of your portfolio. It gives you a chance in terms of your yield of at least trying to keep pace with the inflation rate. And if you can do that and you build it together in a nicely managed way, reinvest as interest rates are going up, it gives investors a really good shot of trying to maintain purchasing power today. So again, these non-traditional markets, they have higher yields than the traditional markets today. They have attractive return potential. I said, some of these assets you can even buy at a slight discount, meaning they have upside in addition to some of the yield you see out there. You get diversification of cash flows and return streams. We get things from, loan market. We get it from the consumer. We get it from the residential mortgage market. We also can get it, from a little bit of having some corporate bonds in there to get this attractive diversifier today. And hopefully that leads to a lower volatility of your overall portfolio. But most importantly, at least you're giving yourself a chance to try to maintain that purchasing power. And it's very important today. So my key takeaway from this is that you need to look to different alternatives to your traditional fixed income. Again, these are not alternative asset classes. It's things that the team at DoubleLine, many professional investors have used for many decades. These are not high risk assets when talking about, the higher credit quality and the shorter interest rate sensitive assets. It's just they're assets that were not purchased by the Fed, that did not get all that support. And there's not a lot of ETFs that focus specifically on that. So again, we think it's very important to focus on the inflation. It's not just a narrative. It's a real story. It does have a little bit of legs. And just hiding on the sidelines and using cash to us does not look like an attractive opportunity. So I want to thank everyone for paying attention to the presentation today. Thank you for listening, for different ways to try to maintain purchasing power. And please read the disclaimers at your leisure. My compliance team put a lot of time and effort into that. So thank you again. We look forward to hearing from you and your clients in the future. Thank you so much.